Hello and welcome to the video on what is a liability. In simple terms, a liability is something that a business or individual owes or is in debt for. For something to be considered a liability, it must meet four key elements. Number 1, present. The obligation needs to exist at the reporting date of the financial statements. Number 2 is that the entity has an obligation. In other words, the entity is the one responsible for paying and settling the obligation or debt, and they cannot pass it off to someone else. Number 3 is that it is a result of a past event. So the obligation must have arisen from a past transaction or event, such as borrowing money, receiving goods or services on credit, or signing a contract. And number 4, the potential of an economic outflow. This means that settling the liability will require the entity to give up resources, which is usually cash, an increase in cash outflows, but could also be an outflow in goods or services. So let's go back to our friend Red, who runs a delivery company. Suppose Red's company took out a bank loan to buy a second delivery van to help expand the business. The bank loan is a liability because, firstly, it is a present obligation, as the company owes money to the bank and is still outstanding at the reporting date of the financial statements. Secondly, it is owed by Red's company, who is ultimately responsible for repaying the loan back to the bank. Thirdly, the obligation arose from a past event when the company took out the loan and received the money from the bank. And fourth and finally, is that it has the potential for future economic outflows, as the company will need to repay the bank loan along with any interest charged. Thank you for watching. We look forward to seeing you in another video.